In this portion of our discussion about dividend policy, we're going to focus on how dividend policy is put into practice. We're going to keep in mind all of the theoretical things that we've just talked about, but talk about how people actually do this, so to speak. To begin with, I need to do a little bit of background. We're going to be discussing these policies in regard to their payments of dividends versus their priority that this policy gives to reinvestment. It's sort of that dividend now versus growth later to maximize shareholder wealth kind of concept. The thing to note is the amount of money a firm is reinvesting, both debt and equity investing, is called their capital budget. So as I go through these, I'm going to talk about doing capital budgeting, which, if you've had any kind of background in finance, was what we did with the net present value, internal rates of return, and all of that fun stuff that we're going to be doing later on in this course as well. But I need you to understand that the capital budget is a firm's attempt to grow their company, essentially. It's replacing old machinery with new machinery, or just expanding with new machinery. That's their capital budget. And so the amount of money that a firm has to reinvest, both debt and equity, is their capital budget, whether they're putting in new chunks of equity and debt. And remember, they usually want to keep those pretty much the same. Talk about that too in just a bit. So the dividend policy is important in capital budgeting decisions because accumulated retained earnings cannot go negative, although companies can pay out more than they make over the short term as long as they have some retained earnings on their balance sheet. And this is really an accounting issue. It's not whether or not they can afford it with cash. We're going to look at dividend policy and look at these proposed dividend policies. Now, they're proposed because in some instances companies say this is what they're doing. In some instances people just say this is how I'm going to model it. And in some instances this is really closer to what companies do with dividend policy. So we're going to start out by looking at what's called residual dividend policy. If you read a 10K report, 9 times out of 10 they'll sound like they're doing this one. Second, stable, predictable dividend policy. This is where we hit a specific amount of dividend every single time, no matter what. Stable, predictable growth rate is kind of the same sort of thing, only in this instance the message we're trying to get across is that the growth rate goes up a certain amount. This is growth in dividends. Third, constant payout ratio. This one is really easy to do if you're modeling a company, and because it's so easy to model, people usually fall into this trap. It is a trap because nobody actually does this, and I'll explain why when we get there and talk about it. And fourth, low regular dividend policy, where we're keeping our dividends fairly low but constant. It's sort of like that stable, predictable dividend policy. But then as we accumulate a whole bunch of cash, we declare huge dividends on an occasional basis. Seems like it might be a good compromise, but I'm going to tell you why that probably isn't. So for instance, I'm going to go through these now in greater detail and tell you what they actually mean as far as dividend versus growth is concerned. So to begin with, residual dividend policy. This is the one that in your 10K, if you read your 10K quite often, I'll have students who say that's what my company does because that's what they said they do. And what they are saying is that investors prefer to have the firm retain and reinvest earnings if they can earn a higher risk-adjusted return than the investor can. That just makes sense. So residual dividend policy suggests that dividends should be that part of earnings which cannot be invested at a rate at least equal to the weighted average cost of capital. This one makes a lot of intuitive and academic kind of sense. The problem is that it's not really what happens, and I'm going to tell you why. Because in this instance, the residual dividend policy, you would determine your optimal capital budget first. In other words, find all those projects that will give you a higher than weighted average cost of capital return on your investment, and then with whatever's left, first off, based on that budget, you'd say how much of that has to be retained earnings to maintain my debt to equity ratio at where I want it. And then based on that, use the retained earnings to supply as much of the equity investment in the capital budget as necessary, and with the rest of it, you pay your dividends. Now, the problem with this one, of course, is that one year I may have huge amounts of optimal capital budgeting projects, and the next year I don't have very many. Maybe that's because there was an upturn in the economy followed by a downturn in the economy. And if that's true, then all of a sudden my dividends are going up and down and up and down and up and down. What did we say about cutting dividends? I keep having to remind people this because they say, okay, I got what you were saying about dividends, and then all of a sudden when we try to apply it, they completely forgot everything that I said about dividends. The point of this class is to get some application. That's why I'm saying at this point, residual dividend policy sounds good. It's probably not what any firm is actually doing, because they would be sending the wrong signals to the market. Second, stable, predictable dividend policy. Due to the possibility of a negative signal to investors, many CFOs have set the policy of never reducing their dividend. Dividends are only increased if management is really certain that future earnings will support such a high dividend. This one happens all the time. So they'll set a dividend policy, they'll stick that number there, and they will never go up and never go down. They only go up if they're pretty darn sure they will never, ever, 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 ever have to cut it. A very close variation to this one, which is why I did a 2A in my list, is a stable, predictable growth rate. With the stable, predictable growth rate, we're actually trying to send a message to the market that the growth rate is stable. Therefore, you can estimate your G at such and such, and based on that, you can do a really easy dividend discount model and figure out approximately what the value of that stock is. In that instance, the company has to set the policy in such a way that the growth rate can be sustained for the foreseeable future. This one's a harder one for companies to do, but there are companies out there who are doing it. If you're doing this type, the stable predictable dividend or the stable predictable growth rate policy, number one, you pay your dividend first. Then you base your optimal capital budget on what's left over in retained earnings after the dividend. Dividend comes first. Third, and this one quite often, by the way, is the way people like to model their dividend policy, and then I will say, no company would ever do that. It's possible that a company could set a policy to pay out a certain percentage of earnings as dividends. In fact, I've seen this claimed in some 10K reports. It's like we pay out around 30% of our earnings. What they're saying is over the long run. You can't model it that way, because over the short run that's not what happens. Because what happens if they ever cut their dividend, and their earnings will go up and down, and earnings are all over the place. So the problem with this policy is that it wouldn't fit the needs of the firm's stockholders, since it would cause a great deal of volatility in dividends paid, and we would be cutting our dividends on a fairly regular basis. It's probably not going to happen. So here's what you'd end up having to do. Earn your money, apply the certain proportion to the dividends, and then base your optimal capital budget on the residual retained earnings, which makes no sense. It's an arbitrary percentage. Makes no sense. And the final one is the low regular dividend plus extras. It's meant to keep expectations low for dividends, and then as we get extra dividends, we pay it out as a bonus in good years. The problem is the potential for negative signaling. And the reason I say that is because even though you're saying here's where we want your expectations to be, if you continually pay out bonuses every other year, for instance, your shareholders will come to expect it, and then those years when you say, oh, I didn't pay the bonus, but that's no big deal. It is a big deal. They came to expect it. And so it's impossible to get these extras to actually be extras if you do them on an anything close to regular basis. If you were to do one of these low regular dividends with extras, here's what you do. Pay your predictable dividend every year. In years with good earnings, pay a bonus dividend. Base your optimal capital structure budget on the residual of regular dividend and compromising with the bonus for capital budgeting projects. Again, your fixed dividend becomes a priority over and above your capital budgeting. It's a key element of any discussion having to do with dividend policy, is when you set that dividend policy, it becomes your priority. Let me take a look at a few real companies. These are actual companies. They're not made up companies. This is General Motors. And yes, it's only going up through 2001, but don't worry, we'll get up to today. So in the red, with the red line at the bottom, we find the dividends per share. That's what DPS stands for. The earnings per share is the black line. And by the way, if earnings per share goes below dividends per share, this is unsustainable because you're going to be starting to pull more money out of retained earnings than you're putting in. So eventually you would run out. The question that I have at this point is, first, what dividend policy does it appear GM was trying to communicate to the market? Let me be kind of clear here. In 1993, they were paying 80 cents a share. In 94, they paid 80 cents a share. In 95, they paid $1.10. In 96, they paid $1.60. And then from 97 on through at least 2001, they're paying $2 a share no matter what. So based on our understanding thus far, what dividend policy are they communicating to the market? The answer should have been, that you should have said, is a stable, predictable dividend policy. They're saying $2 no matter what. You can feed Fluffy and be sure that Fluffy will be fed forever at $2 a share. In 2001, they actually earned less money than they paid out in dividend. In other words, they paid out more than they actually made by just a hair. Why did they do that if that's unsustainable? The answer you should have been saying in your mind or out loud and making everybody in your room feel like you're on drugs, especially if you have earphones on, is that they wanted to signal to the market that everything was going to be okay and that this was a temporary downturn. Was it a temporary downturn? Okay, maybe not so much. So in 2004, they dropped a little bit below. In 2005, they really lost it. And in 2005, they paid their $2 a share anyway. Again, they were trying to send the message this is temporary. Things began to hemorrhage badly, though, and the market began to say, are they long for this world? At which point, after much consternation, they decided to cut their dividend. Now, you know in this discussion what we've been saying about cutting your dividend. But it took forever. You can see how long after they lost money they actually cut their dividend. It wasn't until 2006 that they dropped their dividend to $1. And what that means is they were trying to send the message that everything's okay, don't worry about us, we're fine, we're going to be all right, and so will Fluffy. Until the last possible second when they had to say, okay, we're going to cut the dividend. They cut it actually in half to $1. And these are annual dividends. I should mention that when we were looking at Caterpillar earlier, we were looking at quarterly dividends, and these are annual dividends. So they cut this to $1 a year in 2006, which means they paid 25 cents a quarter, which is ironic because that means that they paid a quarter per quarter. But anyway, they were trying to send the message that everything's going to be okay, don't worry about us. We'll weather the storm. But in 2006, when they actually dropped their dividend finally, their stock price actually went up despite what I said, but that's because the markets were long anticipating that they would have to cut their dividend. And when they finally did cut their dividend, they said at least they'll be around longer, so that you may be able to get a decent return on your investment. Now, I'm going to point out, whether people think it's politically correct or not, that all of these things, all of these troubles began happening long before our economic downturn. And so then, as you may well be expecting, in about 2007, 8, 9, the real crap hit the fan. And yes, went up in 2006 only to go into the toilet in 2007. Jumped up a little bit in 2008. And then the earnings are too screwy in 2009 to even report. And then I started reporting them again in 2010 through 2013. By the way, just so you know, in 2007 they maintained their $1 a share. 2008 they went to 50 cents a share, and from 2009, when the government took over temporarily General Motors, they dropped their dividends per share to 0. In the last few years, their earnings per share has been above their dividends per share. That's the good news. Bad news is it looks like there's a bit of a downward trend from 2011 on. But, that's General Motors. I'm hoping that all of this discussion as to how they came up with their dividend policy makes some sense, because I'm going to be asking you to anticipate what your company is going to be doing in future. It's probably not going to be a GM. So let me give you a better example, which is, in this case, Caterpillar, because I've been starting with Caterpillar. So here's Caterpillar's, again, the red one is the dividends per share. The black line here is the earnings per share. Note that in this, at least so far, the red line has stayed well below the black line. And in fact, the black line just took off in about 2004, 2005, 2006, and the red line did not go up anywhere near as precipitously. Let me also point out that in 1993, the dividend in Caterpillar was 7.5 cents. Every single year from then until until now, their dividend has gone up every single year by year. Some of it not much. So from 2002, when their dividend was 70 cents, and this is per year, whereas that's how much they're paying, as you noted earlier in the lecture, that's how much they're paying per quarter now. And 2003 they went up to 72 cents per share, not much of an increase. So my question at this point is, when their earnings per share shot way up, why didn't they make their dividends per share shoot way up as well? What dividend policy do you think they're trying to communicate to the market? In this instance, what you should be thinking is a stable, predictable growth rate. It may not be completely stable and predictable, but it's kind of close. And I think that's the message they're trying to send to the market. We're actually growing at a regular basis. Quite frankly, there are two ways that companies typically grow their dividends. Sometimes it's at 1%, which is what we talked about earlier, but quite often it's also a fixed amount, and that's usually much more common among many companies, is they'll grow their dividends at a specific amount, like it will grow at 5 cents a year or something, rather than 1%, because over time that fixed amount is a smaller and smaller percent. Anyway, this one takes us up through 2007. But if we go just 2 more years, you'll notice that between 2008 and 2009, first off, the dividend went up only from $1.62 to $1.68 in a year. But in 2009, the dividend per share was higher than the earnings per share. And again, the question is, why didn't they cut their dividends? The answer, of course, is you never want to send that message. In this instance, when they sent that message, unlike GM, when they sent a similar message and it turned out to be a prophecy of how poorly they were going to do, Caterpillar, on the other hand, ended up having their income just shoot way up until they were making close to $9 a share in 2012, and they only were paying $2.02 a share in dividends. In 2013, they paid $2.32 per share per year in dividends, compared to 1993 when they only paid 7.5 cents per share per year in dividends. Now, having looked at all of these dividend policies in real companies, I'm hoping that this gives you a sense as to how to look at dividend policy in a real company and say what's going on, what messages are they trying to send, and what are the messages they're trying to get the market to buy into so that they can use that to analyze the price of their stock. I should mention one last little thing on Caterpillar, and that is that these last couple of years there's been a major downturn in earnings per share, but at the same time there was actually an upturn in the dividends per share, which is an interesting counterpoint. And I think what the company is trying to say is, we are so certain that this downturn is only temporary in 2013 that we're actually going to increase our dividends per share higher than we otherwise would have. Now, when you look at signaling, that may actually mean something, and then as you take a look at the signaling effect of this, that we're saying we're pretty darn sure we can do this and never have to cut our dividend, because they never have. Over the past 21 years, they have never cut their dividend. So they're sending a very strong message that our growth rate is fairly strong, and they're hoping that the market actually buys into it, because if they do, they're going to put a higher G in that formula, and voila, their stock price is going to go up a hair. So having said all of that, and hopefully getting your mind thinking about what could I do to see what my company is doing, and we'll come back to that because that's what we're going to be doing in the homework. There are other alternatives for companies who want to improve the value of the stock to the shareholder, at least in paying them back. The biggest one is using a stock repurchase. Stock repurchases are buying stock and putting them into treasury. The place where we can actually see how much money your company is repurchasing in stocks is in the cash flow statement. And so to help me get to the cash flow statement, I'm going to the 10K report. This is Caterpillar's 10K report, and it's actually under Exhibit 13 that has the financial statements. This one's the income statement. I'm hoping most people can see that, even though it does not say income statement, at least if you pushed pause long enough to see that. This one is financial position, which is another word for, yes, the balance sheet. The only one that actually has the right name on it is this consolidated statement of cash flow. This one's a cash flow statement. As you scroll through this cash flow statement, the treasury stuff is always picked up in the financing activities. It's found generally somewhere in there if they're doing any purchasing at all. This one is saying that they spent 2,000. Now these are probably in millions, and if so, that would be 2 billion. And these are in millions, so that is $2 billion. So they bought back $2 billion worth of stock off the market. And the reason that this works in lieu of a dividend is we're now splitting the earnings per share over fewer and fewer and fewer shares. We're just buying them off the market, and everybody therefore who owns shares in the company kind of owns part of those shares, but really what we've done is we've taken them off the market, so they're not even taken into account when we take into account the number of shares outstanding. It should be also pointed out, however, that the dividends that this company is paying, these are the total dividends, not per share. They paid over $1.1 billion in dividends this year, $1.6 billion the year before. And you may say, I thought they were going up every year. Yeah, they would be going up every year, except they bought back a whole bunch of shares, so they don't have to pay them any dividends. So that's giving them a little bit more room in which to expand their dividends per share because there are fewer shares out there. And at the same time, going back up to their balance sheet, they're buying back treasury shares, which are these negatives right here. And yet the profit employed in the business, which in this case is what they call their retained earnings, has still gone up. So they didn't even use all of the earnings that they made to pay dividends and repurchase stocks. So treasury stock, companies buy back treasury stocks. The firm value is divided then by fewer and fewer shares, so should have an effect on the market value of the remaining outstanding shares. This can be reversed in that the company could then just turn around and reissue those same shares that they bought back. The other benefit to repurchases is I'm actually giving extra dividends to people who want it, which really goes back into the clientele effect. I'm paying people the cost of the entire stock to those people who want to cash out on their investment of my company. So it's kind of a nice all the way around way of dealing with paying my investors back. I should mention really quickly that not all companies are actually doing that. They don't all have to be doing anything with their treasury stocks. This is Rocky Brands, and this is their financing activities. They have proceeds from revolving credit facility repayments of revolving credit facility, proceeds from long-term debt, repayments of long-term debt. So far we're just talking debt. Dividends paid to common stock, which they never have done until just this most recent year. And then debt financing costs. So far I haven't seen anything having to do with treasury. Issuance of common shares, so they actually picked up $14 million by issuing some new common shares. Proceeds from exercise of stock options, 4 of the 6 years, and then tax benefit related to stock options. Based on those, based on what's listed here, there was no purchasing or repurchasing of stock into Treasury. Just wanted to point that out. If you're not seeing that, then they aren't repurchasing. And in fact, if we go down and look at their balance sheet, we don't see anything here that says anything having to do with repurchasing of shares, because they didn't. This can be a great option for temporary cash inflows. It's probably a better option in most instances than those extra bonus dividends. But again, we have to watch to make sure that we have enough retained earnings that we can use this instead of a regular dividend. The things that people usually see as alternatives aren't really alternatives at all. There are things called stock splits. With a stock split, what you're trying to do is maintain the stock's market value in line with what the market seems to want to have to pay for stocks. Let me give you an example of this as well. In this instance, I'm going to go to finance.yahoo.com. I'm going to look up the company that's called Columbia Sportswear, COLM. Ooh boy, I'm stumbling all over my keyboard here. This company sells coats. If you've ever bought one of those that says Columbia on it, they're really warm coats. May not need them quite as much in Texas as you might in like Illinois, Indiana, Minnesota, those places. Their stock is currently selling, at least when I'm recording this, at $35.95. I'm going to go take a quick look at their historical prices. And as I look back through their historical prices, I note that just less than a month ago, they had a 2-for-1 stock split. What that means is anybody who had any shares in Columbia at the day before the stock split, the shares were selling at $74 a share. You're going, but they're selling at $35 now. Exactly. Because what they did is they took that one and they tore it in half and they said, now you have two. You still own the same proportion of shares in the company. However, at this point, you own twice as many shares, because all we did was we doubled the number of shares, and for every share that you had of the old stock, you now have 2 shares in the new stock. Because $74 a share is a little pricey for where they think their primary clientele are. They want stocks around the $35 range, so to speak. Now, you can do a regular stock split, or you can do what's called a reverse stock split. And a reverse stock split, you're going in the other direction. So you could have been going from 35 up to 74. Usually they are much smaller than that. For instance, the New York Stock Exchange requires their shares to sell at a minimum of a certain dollar amount. They don't have a maximum, but they do have a minimum. And if you get below that, you're going to have to do a reverse stock split or be delisted from the New York Stock Exchange. And so companies might want to do a reverse stock split in those instances. The other extreme example of companies never doing stock splits, what would happen if you never did a stock split? Well, as it so happens, there is a company out there that's never done a stock split. It's Berkshire Hathaway, A stock, which for 1 share of their stock, you would have to pay today $209,251 per share. So if you're buying like what used to be called a round lot, which is just 100, the smallest round lot is 100 shares, you'd be paying around $20 million for that. This company has never split their stock, and if we went back to 1980 to find out what it used to be trading at, in fact, let me do that really quickly. I'm going to download the spreadsheet. You'll find that this company has never, ever, 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 ever split their stock. Oh, by the way, I better take a look at the close and the adjusted close. Let me view, freeze my panes, and then I'll have my headings up there as I scroll all the way down to the bottom. And you'll see that originally, and back in 1980, in fact, let me zip that out, March 17th, 1980, this stock was selling for $290. And today it's selling at almost 1,000 times that, at $209,251. They've never split it, ever, no matter what. So sometimes there are some signaling effects with stock splits. So for instance, if the company is selling really well below $1-ish, and they're selling on the New York Stock Exchange, or they may have just barely gotten underneath that, we don't think they're going back up, or if they're even coming close to going below that lower bound on the stock, and they do a reverse stock split, they're saying, we've given up, and we know it's going well below. So there can be some signaling effects in the price of the stock, but usually there aren't in a stock split. So for the most part, stock splits don't affect the value of the stock at all. Companies sometimes offer what are called stock dividends. With a stock dividend, they issue stock in lieu of cash as a dividend. So instead of getting like $1 a share, you may get 10% of a stock per share, or maybe less. It costs the firm very little, doesn't benefit the shareholder that much. The pie simply sliced in smaller chunks. You still usually own the same proportion of the company. It's just what I would call a slow motion stock split. So rather than have to split the stock every few years, you just offer stock dividends, which allow the number of shares to grow. But some shareholders get really freaked out when they get all of these really bizarre, I bought 100 shares, now all of a sudden I have 125. Where in the crap did the 25 come from? Well, they came from stock dividends. Another way that current shareholders can actually buy new shares if they want to expand their holding in the company is through what's called a dividend reinvestment plan. Now notice I colored the I in dividend reinvestment plan in the heading a different color, because then you get the DRIP, DRIP, which is where the term DRIPS comes from. So DRIPS allow shareholders to opt to use their current dividends to buy more shares of stock from the company. It can benefit both the company and the shareholder, because they can both avoid some transactions costs. The company doesn't have to go through an investment banker. The individual shareholders don't have to get brokerage fees. Sometimes the brokers will actually charge them a fee for doing the transaction, even though they didn't do much. They just processed a little paperwork and that was it. If the firm uses this program to issue new stock, then the current shareholders not participating may find their ownership percentage to be diluted, meaning all of a sudden I used to own X percent, now I'm owning less than X percent of the company, and I didn't do anything. It's just that there are more and more shares coming out. Unless the company is buying back some shares into the treasury, this can be a not so great idea. For those who are using a more passive investment strategy where they buy and hold and don't adjust very much, this can be a not so great idea for them. That's the end of the topics in the actual chapter. What I'm going to do in the next video is go over the homework that I'm going to ask you to do for this chapter.